From the morning reading, small cap IWM leads, the Qs lag on weakness in Amazon, Facebook, and others. 8 of 9 sectors moved higher on Thursday. XLI, XLB, and XLE were the strongest sectors, while XLV was the weakest sector for the third straight day. Oil futures rose $3.07 to close at 41.67. Breadth strengthened as decliners led advancers 3.87 to 1 on the New York Stock Exchange and 2.17 to 1 on the NASDAQ. The SPX made its highest close in 2016 and is down just 3 points since December 31st, 2015, and on the verge of being positive year to date for the first time this year. The VIX made its lowest close since November the 6th of 2015. The small cap IWM was the strongest broad market segment, while the Qs were near unchanged on weakness in Amazon, Facebook, and several healthcare stocks. In other morning reading, economic reports are beating expectations. The Citigroup Economic Surprise Index is about to turn positive after having spent months below zero. That seems like it should be a positive for stocks, but many times stocks had already rallied by the time the index turned positive, so forward returns were muted. Precious metals, however, did tend to rally, while the dollar and some agricultural markets struggled. New highs surged on Thursday on the New York Stock Exchange, the most number of securities traded at a 52-week high since last March, nearly a year ago. This is unusual since indices like the S&P 500 are still more than 4% below their own highs. Investors are coming back into emerging markets. The most active ETF that tracks emerging markets, the EEM, has seen $1.2 billion in inflows over the past week. ETF flows can be difficult to use since shares can be created for both longs and shorts, but in some funds like EEM, they continue to work as a contrary indicator. In the past, when flows have exceeded $1 billion in a week, it has usually signaled exhaustive buying or selling pressure, suggesting this is a headwind for the fund in coming weeks. Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:34 a.m. Central Time, and I'm recording this in preparation for the market day of March the 18th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and go to the morning report. And on all 4 of the broad market U.S. indices, we're up a little bit, not big, but about 0.25% on the S&P, a little over 5 points. On the Russell, the same as we are with NASDAQ and Dow, all up about 0.25%. Crude oil up about $2.08, up over 5%. Euro down about 0.4. Bonds up about half, and gold down about 0.8%. And overseas action, a little bit mixed in Asia. China is up 1.73%, Hong Kong up 0.8%, but Japan is down 1.25%. In Europe, it's all up. Germany up about 0.33%, United Kingdom up about 0.5%. In terms of macroeconomic reports for the United States, today we have FOMC member Dudley speaking before the market opens, and then during market hours should be the University of Michigan Consumer Sentiment, and then preliminary University of Michigan inflation expectations. FOMC member Rosengreen also is speaking, and then after the market closes, you have FOMC member Bullard speaking. So they're busy on the FOMC circuit this day. So let's go to volatility. And we can see that skew just a little bit elevated, just barely above the warning status. Short-term VIX, though, it's the lowest we've seen. In fact, one of the morning reading authors mentioned about the VIX being the lowest it's been in some time. Short-term VIX just below 13, just around 13, I should say. And in terms of IV percentile, these numbers are also about the lowest we've seen in a very long time. S&P at a 13, the Russell at an 18, the NASDAQ 16, and the Dow at a 7. Notice that we had standard deviation moves put on a close-to-close basis, and both the Russell and the Dow yesterday, both up over 1 standard deviation. And in terms of the charts, let's go on to there. And you can see the action that we've been talking about here of late. It's just amazing bull. I mean, after so much weakness, when you had the double bottom and so forth, we have just been absolutely on a tear. I mean, it was not that long ago we were fearful of breaking 1800 about 4 weeks ago, and here we are, you know, about 250 points higher and within 4% of the all-time high. So just an amazing run here, and obviously as we've made this run, the warnings have ebbed off, and many of the flags that we had back here have all gone away. There's very, very little in terms of warning status left. In terms of current expectations, there's just really nothing up until you get up to this 2080 area, so it could easily run another 30 points, perhaps with another bull flag or two, but that's all you've seen in all this run. Bull flag, bull flag, bull flag, bull flag, bull flag. I mean, it's just been the little bullish continuation patterns, and really nothing more serious than that in a 250 point type of run. So just run, 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 and it's very hard to get out in front of these bulls because they just keep running so hard. In terms of the Dow, it's, you know, can it be even any stronger? Of course, these are the two more defensive indices, but just look at this. I mean, it doesn't even have that much relative further to go to get back to these swing highs here, and that would be the first place where you could paint any kind of logical kind of resistance to this area now that we've busted through, you know, the resistance areas, the very important resistance areas that were in this area and then this area. And you see there was cause for pauses at those areas, but not for long. In most cases, more than 2 or 3 days, and it was off again and running again. In terms of the NASDAQ, we've seen a bit more relative weakness in the NASDAQ, and one of the morning author readers mentioned about Amazon yesterday, but still, you know, it continues to power on. It continues to move through areas of resistance just a bit more reluctantly, and certainly it's a long ways to go to catch up to these former swings. So we'll continue to watch that difference. I mean, it's still bullish. It's still, you know, moving forward through areas of resistance. It's just not making that kind of big, heavy run that you expect from the technology-laden NASDAQ or those kind of higher beta growth-oriented companies. You expect them to kind of lead. And the Russell, of course, small cap, also growth-oriented, and it seems to be in relative distress by the greatest degree. And in fact, it's certainly not making just a series of bull flags after having been just incredible up to this point. And remember, when we got to this point, you know, it seemed like, wow, we've closed outside, but then we had the big reversion and nullified this breakout, and it's basically chopped in a consolidation range ever since then. So going to be also interesting to watch the Russell. So the Russell and the NASDAQ, you know, showing some signs of relative weakness and some signs of not wanting to participate to quite the same degree as the Dow and S&P bulls are doing. In terms of the bonds would seem to be something contrary. They're starting to move up. Though you could say this is still, perhaps we could even draw a channel on this, and perhaps it's at the top of the current channel. So we'll have to see if that truly gets any momentum. If that does that, that might be a sign that equity is starting to perhaps exhaust. And gold has been on an interesting move here. You had the breakout. There's just beautiful pattern here. Then the form of the pennant, the breakout of the pennant, but then that then seemed to break down. In fact, we had a really ugly close down below all this support, just to then 2 days later come roaring back up into the prior area. But not really any kind of follow through with a higher high. And in fact, right now this is a lower high. Get that right, a lower high. So we had a higher high and then a lower high, and you know, so we're going to have to see where this starts to go. But you know, just when you think you have figured gold out, it does something kind of strange, and it kind of invalidates your premise. And let's take a look at volatility. And just other than just in a channel on the downside and continuing to ebb down, there really isn't anything here that screams to us that we're about to have a reversion in the markets. So we're get ourselves back down into the bullish range of volatility again, albeit at the very high end. Kind of think of the bull range as that 12 to 18 area, and especially below 15. But you know, hey, it's been a long time since we talked about the VIX futures being below 18. Let's go to our daily report, and this continues to get better and better. Intermediate term phase opinion, very bullish phase 4, price patterns near horizontal resistance. This is your combination of bull flags and other similar patterns. The 3 market timing mechanical signals, the first one from IBD, confirmed uptrend, though we do have a bit of a warning from the accumulation distribution. Continues to be relatively weak, with the NASDAQ at a D+ and the S&P at a C-. GMI index, though, a perfect 6 out of 6 now, and that buy signal's been in place since 3/2. On our third mechanical signal, decision point scoreboard, you notice that we've been looking for this stack to come into play on the intermediate term and to start to get some agreement between the short term and the next layer up. And we now have, you know, a preponderance of bullish signals coming from the intermediate term, with just PMO signals on 3 of the 4 showing, you know, some still hesitation. So still not an all clear, all green, all time frames kind of stack of everything yet. But clearly the bias, when you put these mechanical signals together, is that we're still a market in transition, but the bias continues to be bullish. In terms of position sizing opinions, we are 100% on both systems. Intermediate term market posture, very strongly bullish, with a supportive, weak bullish sentiment line, but that sentiment line, while weak, continues to also improve. Notice that all 4 of them are back up over 90 again. Very, very strong bullish intermediate term market posture. You notice the strength of the trend is, again, weak bull, but improving. And then in terms of her hedge warning status, we remain at 0+, normal, with some elevated risk conditions, but certainly not a lot of elevated risk conditions. The primary problem here is that we're still in this transition zone. We don't have our time frames all stacked up, and we need, you know, new higher highs, you know, all-time higher highs, higher lows, you know, to really kind of be a full-out zero. So we've got a little bit of work left to be able to get to that, but certainly we are a long way from 1800, which just a few weeks ago we were at. In terms of strategy opinions, option income strategies, the VIX is absolutely acceptable to initiate new positions for novice traders. Everything's pretty much normal in terms of the environment to be able to manage option income strategies. If perhaps there's anything that's not normal, it's that we're just kind of a one-sided market, and of course most option income traders are delta neutral traders, and you've probably been getting pressed on the bullish side on everything that you've been doing with option income strategies with these kinds of just run-on markets. In terms of covered calls and put selling, of course, those same conditions are beautiful for these strategies. We're still somewhat defensive in that we're 1-to-1 ratio of in the money and out of the money, and we're also 1-to-1 ratio of low beta and high beta. Remember, those time frames are still not all stacked and healthy. This is not a healthy bull market. It's just a much improved market. So keep that distinguishment in place while you're constructing your positions. And on some of those more aggressive setups, you might want to be conservative by coming with a well out of the money put to leg into that cover call on some of those positions. Put selling, just keep those position size and the scale that you're willing to own in case we get some sort of retracement and you find yourself getting significant heat on positions that you're not really truly willing to own. In terms of our special warning areas, and you see in terms of volatility base, there's really only a couple things that are flagged in warning status at this time. We do have a volatility ratio warning that's back to back now. 2 days that we have had that warning fire off. The skew is just barely above the warning status, so we've got about a 10% probability of a 2 standard deviation move to occur within the next 30 days. And lower, we got one of the key intermarket risk aversion indicators is now rolled over as risk off. And then I think one of these first two, I can't remember which one of these, was also rolling over, though it had not yet crossed over to give a signal as risk off. So be aware, this is the kind of stuff that we look for from the intermarket risk aversion indicators. We think of this as kind of like the tide going in and out. And as these start to turn and you start to see now the first one and then maybe the second one comes in and then the third and then the whole risk off starts to kind of play again, you're starting to get those early signs that perhaps this big bullish move is starting to run to its extremes, and perhaps we're setting up for something of a more significant a pullback. Nothing that we expect to invalidate this short into intermediate term bull, but that we might slow back and have something of a pullback into this bullish move. Certainly would be called for, there's no doubt. In terms of indicators from our sentiment group, we see that stocks short term are getting relatively high at an 8, gold's also at a 7. And in terms of the fear and greed index, you can see it's also up into the extreme greed quartile. So what we look for with these sentiment indexes is not necessarily an intermediate term reversion just because they're high. What we look for is signs of a potential reversal pattern. These can stay high for extended periods of time. These ETFs here are also very high in their sentiment, so also be watching if you're in any of these positions for potential signs of reversal. In terms of the sector-specific intermediate term market postures, you notice that we've got a very, very broad list here at this point. So this is not just defensive anymore. It is increasingly, look at NASDAQ's here since 316. We've got a lot of players coming in here. Commodities are in here. So at first we saw the TLTs and the gold and many of these defensive sectors, but this has clearly become much, much more blended here of late. And this is a long list. In fact, I'll have to kind of scroll through so that you can even see it all. In terms of percent change, you can see we've got just about a sea of green across all 3 time frames on all the sectors, with the exception of healthcare. Biotech continues to get hammered. In terms of percent change, very big day yesterday. Materials, industrials up over 2%. Many others up over 1%. But also notice utilities up over 1%. In fact, of one of the sectors that's been performing in all these time frames and is green all the way across the board is utilities and telecom. So we continue to see that utilities, telecom, and consumer staples, the 3 most defensive sectors, continue to put in the most consistent performance in this market, though we start to see more and more coming from these higher beta areas. Okay, we're just about at 20 minutes, so let's go ahead and wrap this up for today. We'll say that if you would like to get emails from us, and we send out only a limited number of emails, just go to this website, scroll down just a little bit. You'll see a button here. Click on that button. When you click on the button, it'll ask for your name and your email address, and then you'll get all signed up. We also send out a limited number of emails related to the hedge risk level changing, kind of an alert there, as well as periodic blog articles and other items of interest. We will not pound you on the emails. We'll just try to keep it very, very helpful and business only. If you want to do that through your smartphone, just text Falcon Global, all one word, to 22828, and that'll get you set up as well. As always, retweeting us to your Twitter followers, to your StockTwit followers, liking us on YouTube. Those are all ways to say that you find what we're doing here with this Falcon Global Market Preview is helpful to your trading. We appreciate those pats on the back when you retweet us and like us on YouTube. I'll scroll through the rest of this today. If you see something you want to spend more time on, just hit the pause button and you can go to that hyperlink and get additional details. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you note the full set of disclosures can be found at that hyperlink down there at the bottom. We'll see you back here next week with the Falcon Global Market Preview. Good trading.